righty. Good morning, everyone, and welcome to the 2023 Multicoin Summit. We appreciate you all coming down to Austin, Texas. Over the last couple of years, my presentation has been pretty focused on the future, talking about all kinds of crazy, wild things you can build using composability. I thought it'd be nice to change things up a little bit this year and talk a little bit less about the future and a little bit more about the present. The most salient debate happening in crypto today is about how to scale blockchains, and primarily in the context of modular versus integrated approaches. So I want to address that debate from two perspectives, in theory and in practice. The first half of this presentation will focus on the theory side, and the second half on the practice side. So with that, let's begin by jumping into the theses themselves. There are three major kind of functional components to a blockchain. At the bottom, you've got data availability, which is kind of being rebranded these days as data publishing. And then on top of that, you've got settlement and execution. I'm not going to get into the specific definitions of these terms, as it's actually not too important for understanding the broader theses. What is important is understanding the basic general premises of the modular and integrated theses. The modular thesis kind of roughly states that each of these three layers is a functionally separate thing, and that you can have different teams build different software systems that are optimized for each of these different components, and that then application developers will end up wanting to basically use these as Legos, mix and match them in different ways and configurations, tweak them, fork them, make whatever kinds of optimizations they deem fit for different kinds of applications. The integrated thesis, on the other hand, basically says, hey, we know what the right use cases are for these systems, and we're going to optimize the entire thing from the ground up around a handful of known and understood use cases. These theses are not mutually exclusive. They can coexist, and they probably will. The modular versus integrated debate is not new. It's taken place dozens of times over the history of technology over the last 40, 50, 60 years. And it's, in fact, this debate's appeared in many of the most famous business books about technology over that period. Probably the most iconic would be Clayton Christensen's The Innovator's Dilemma. And the core premise of that book, basically, is that modularity led to the rise of Windows by using hardware modular suppliers to make the components cheap and to allow scaling out PCs. But of course, in that vector, the primary thing that mattered was cost. It was just driving down hardware costs. My point here is not to say that modular is right or wrong or cheaper or faster, but rather to highlight that this is not a new debate. There have been a lot of instantiations of it, and there are going to be a lot of instantiations of it in the future. Sometimes modular is won, sometimes integrated is won, sometimes it's been a draw, and sometimes one of them is won only to have the tides reverse as technology has continued to progress. At a high level, the modularity thesis started to broadly take over technology starting around 1985 with the rise of MS-DOS and the Windows era. For roughly the next 20 to 25 years, that became the dominant paradigm in computing, and things actually started to shift back in the other direction with the launch of the iPhone in 2007. But even when the iPhone launched, it actually wasn't clear to most people for still another handful of years that the tides of technology were turning back towards integration. The one thing that becomes clear as you study the history of the incarnations of this debate is there is no single framework you can use to determine a winner. In each instantiation of it, the technologies are different, the nature of the network effects are different, the politics, the distribution, all of these things vary. And so ultimately, there's no one way to think about these questions. Today, then, I'm going to walk through that analysis from first principles. One last comment here. The crypto community has tended to use the word monolithic to describe integrated systems. The historical literature on this one is pretty clear. The debate is modular versus integrated, and so we're going to work with that terminology. All right, and with that kind of context set, let's get into the analysis. To start, I'd like to ask a simple question, one that we often take for granted, but that's worth revisiting from time to time. What do blockchains do? Blockchains keep track of who owns what. They're asset ledgers. You can own fungible assets, non-fungible assets, whatever. But they just keep track of a list of stuff. Well, what can you do with a list of who owns what? Broadly speaking, two things, trading and payments. If you think about how economic activity is generally described and understood, basically all of economic activity maps to these two functions. GDP broadly maps to payments, and all of Wall Street and finance broadly maps to trading. Blockchains happen to be very good at handling these money movements or these asset movements. Well, the next logical question is, what are the ideal properties of trading and payment systems? The answer is actually pretty clear. You want them to be fast and cheap. Or if you want to be a little bit more scientific, you would say you want low latency and consistently low gas fees. Latency is the amount of time it takes for a transaction to be processed successfully, and gas costs are, of course, the cost it takes to actually execute and process it. Today in the presentation, I'm not going to talk very much about latency, as it's a pretty static concept, typically a number measured in milliseconds or seconds. We're going to instead focus most on gas costs, because gas costs are a lot more dynamic and interesting. Gas costs are really a function of three things: compute, bandwidth, and demand load. So over the next 10 slides, I'm going to focus on those in the context of modular versus integrated. Demand is not static, and therefore gas costs aren't static either. Most of the discourse around gas costs is typically framed in a static context. You'll typically hear people say things like, it costs $1 to do a trade on optimism, or something like that. But this framing is incomplete. Demand is both dynamic, growing, and it is very lumpy and spiky. And that means gas costs need to be considered given the inherently dynamic nature of demand. Notably, demand for compute on-chain can scale by a factor of 10x or more in a very short window of time when market volatility picks up and people start trading more. This kind of lumpiness and spikiness doesn't really exist in traditional commodity markets. Take energy as an example. Energy demand naturally ebbs and flows both seasonally and over the course of a 24-hour period, but energy prices tend to be pretty constant over short windows. Contrast this with blockchains when market volatility picks up and trading volumes can increase dramatically in very short windows of time. When this happens, this tends to create very large negative externalities on normal users. We believe if blockchains are ever going to matter in the world at large, that normal users cannot become subject to negative externalities when demand spikes in these systems. So let's look at some of the data around gas costs. Here we can see what happens to gas prices as demand grows. This chart is showing demand for Ethereum block space from 2016 through 2020. The left-hand side represents 0% demand utilization, and the right-hand side represents 100% demand utilization. The y-axis here is the gas costs, and note it is in log scale. The most important takeaway from this chart is roughly when you get to 80 to 90% demand utilization, gas prices begin increasing exponentially. The line basically just turns vertical. Software has traditionally been defined by zero marginal costs. Gas costs were not even a concept in software prior to crypto. For the first 10 years of crypto, from 2009 to 2019, gas costs were not really high enough to deter usage. But starting in 2020, that changed. And for the first time in the history of software, we saw a new economic phenomenon, one that we call anti-network effects. Anti-network effects are a huge problem. When gas prices spike, the system becomes unusable for normal users. Now, there's lots of network effects, and you all have heard lots about them, I'm sure. In most systems, you've heard of, when network effects kick in, if Alice uses the system, it becomes better for Bob. The classic example of this, of course, is a telephone network. The more people who have phones, the more people you can call. Pretty straightforward. In crypto, there are lots of examples of network effects at play, liquidity typically being the most commonly cited. But because of gas costs, there are also explicit anti-network effects at play as well. In the long run, we believe that the limitations that anti-network effects impose on these systems will outweigh all other variables that ultimately determine the long-term success of these systems, because at the end of the day, trading systems must be fast and cheap. So what's causing these anti-network effects to kick in? Well, in a word, demand. What we're looking at here is the Ethereum virtual machine, or the EVM for short. And the way the EVM processes transactions is one at a time, or serially. So as demand picks up, more and more people are competing to get into the system, or in this case, more marbles trying to get through the funnel. The solution to this problem is actually pretty clear. It's to have more funnels, or in computer science terms, parallelism. CPUs have been multi-core for roughly 15 years now, and GPUs have thousands of cores. The way to process more transactions is to have more cores that can do more stuff. Parallelism is it. The most important economic impact of parallelism is that it allows you to think about fee markets in a new way. When all transactions are competing for a single compute resource, then all of those transactions are in competition with one another to be included in a block. And that's why gas prices get bid up. And that holds true even if those transactions have nothing to do with one another. With parallelism, you can make fee markets much more localized. You specifically can have fee markets as a function of each piece of state on the blockchain that transactions touch. What does it mean to have a fee market around a piece of state? Here's 3 examples to help explain that. Let's consider these 3 scenarios. First, we'll start with the 2 on the left. In these transactions, there is no shared state. These transactions are not contentious. Intuitively, if Mary is trading with Nancy and Bob is paying Alice, those have nothing to do with one another. And so those transactions do not share any common state, and then therefore they can be processed in parallel, which means they can be subject to separate fee markets. Now let's consider the example on the right. Here, Charlie and Jenny are competing in an auction to buy an NFT. Here, there very clearly is a common piece of state. In this case, that would be the NFT. Because both of these transactions are vying over the same piece of state, they are naturally in competition with one another, and therefore there should be a fee market for these transactions. The only way to scale computation in these systems is to enable parallelism to support parallel processing of all of these non-contentious transactions, which the vast majority of transactions by normal users tend to be non-contentious. All right, so we've now covered compute in the context of parallelism and fee markets. Next, we're going to get into bandwidth. Parallelism doesn't really matter unless you can get the data to the computer so that the computer can execute the code. And so if you want to maximize computational throughput, you need to maximize how you're going to make use of the bandwidth that's available. Proponents of the modular thesis like to frequently highlight, well, hey, you can have many different execution layers on top of a common networking layer. So what you see happening now is lots of L2s on top of Ethereum, and those L2s could be SVM, EVM, Cosmos. They can be all kinds of different execution layers. The problem with that is you're still sharing a common networking layer. I'm not going to get into the details of networking protocols today. That would be well beyond the scope of this presentation. But if you look at how gossip networks work, it actually is pretty intuitive to the name that's described. It's just people rebroadcasting data to one another kind of randomly. And that's very inefficient. Contrast that with Turbine, where you have a very structured system with how these nodes pass data to one another. Ethereum is a major upgrade coming in about 2 to 3 months called proto-danksharding, otherwise known as EIP 4844. And after that upgrade goes into effect, the total throughput of the system will be roughly 1 megabyte per second. Today, Solana is running at 125 megabytes per second. It doesn't matter how many L2s you have if everyone is still bounded by the same underlying data layer. You're still going to end up having the same gas fee spike up on that chart that I showed a few slides ago. The only way you're ever going to maximize system performance is to leverage all of the available compute and bandwidth that's available in hardware. And the only way to do that is via integration. Integrated systems generally outperform modular ones, and this has been shown time and time throughout technology. The most common example of this, of course, is Apple, who's very well known for their tight integration between hardware, software, and cloud services. But actually, the more pertinent example in thinking about blockchains is actually NVIDIA in the context of training their AI systems. Note the general similarities here. Solana there's thousands of nodes on mainnet today running the system. Each of those nodes contains CPUs and GPUs that have thousands of cores on them. If you look at an NVIDIA training cluster, again, one cluster is composed of hundreds or thousands of A100 and H100 cards, and all of those have to be connected together to run. In order to achieve their performance objectives, both NVIDIA and Solana take a surprisingly similar approach. They build custom software development frameworks. In the case of NVIDIA, that would be CUDA, and in the case of Solana, the SVM. And then they build custom networking protocols. In the case of NVIDIA, that would be NVLink, and in the case of Solana, that would be Turbine. And they tightly integrate those systems as much as possible to deliver maximum performance. I want to highlight networking here because it's pretty under-discussed in the general discourse. Networking is paramount, it's super hard, and no one wants to talk about it because it's ugly and messy. NVIDIA actually bought a company called Mellanox in 2020 for $7 billion. The Mellanox technology is today the foundation of NVLink. This stuff is so important, and they put money to it, and now that's obviously reaping dividends for them in the current market. Solana obviously never bought any outsourced networking protocol. They certainly didn't have the money to do so, but the SVM was built from the ground up with Turbine in mind, so these systems could be tightly coupled. I cannot emphasize enough the importance when you have all of the engineers at the networking layer and the software layers all working together to make the system go fast. The net results of all of this integration can be seen in this chart. Integration maximizes performance, and that pushes out the threshold at which anti-network effects kick in, and that ensures that gas fees stay consistently low. It's kind of hard to see, but there's an orange line running along the bottom there, just above 0. Even when demand loads spike, gas prices stay constant. Consistency is paramount. You just can't build consumer scale software when today something costs 10 cents and tomorrow it costs $6. You just can't run a business that way. Last thing I wanted to touch on before moving on to the practice part of this presentation is standards, or rather the lack thereof. Integrated systems naturally adhere to and enforce a common set of standards for developers and users around the world. Modular systems, by nature of allowing people to mix and match different building blocks and make changes and stuff, by definition do not conform to a common set of standards. They are intrinsically heterogeneous. We can see this clearly in financial markets around the world today. Every one of these exchanges operates on different hours, with different trading rules, different settlement rules, different currencies, different banks, different regulators, etc. Moving money, if you think moving money between US and Europe is frustrating, try doing that while you have a counterparty who's taking on a volatile asset on the other side. The operations teams across banks and hedge funds and trading firms around the world are enormous to manage and deal with all of this complexity and brittleness. For the most part, it works, but every now and again, you do see big counterparty blow-ups whenever there's delays in these various settlement systems. The same thing is playing out roughly in the modular ecosystem today. But the teams aren't called New York Stock Exchange and London Stock Exchange. They're called Optimism, Arbitrum, ZK Sync, Starkware, Polygon, Mantle, Scroll, etc. There's about 7 or 8 of them today, and probably there's going to be 100 of them in the next 12 months. All of these systems are inherently political, and they're all optimizing for their own set of variables, as they should. The problem is that the net effect of all of these teams making all of these independent decisions is that the system as a whole becomes very brittle. And that increases trading costs, decreases liquidity, and it introduces substantial latency and security risk because of the inherent nature of bridges. The beauty of integrated systems is that they enforce a common standard for everyone around the world. And that ensures the capital can flow freely, and that ensures maximum user experience and security for end users. All right, we're 15 minutes into this presentation, and that's the end of the theory part. Before getting to the practice part, let's recap real quick. First, trading and payments are the primary use cases for blockchains. Second, the primary attributes you want in a trading and payment system are that they're fast and cheap. Third, anti-network effects are a function of gas, and they create a firm ceiling on system growth. Fourth, integrated systems outperform modular systems and therefore push out the threshold at which anti-network effects kick in. And lastly, heterogeneous standards inherently produce a fragmented and ultimately net worse financial system. With that, let's get into the practice side. We're going to talk about 2 major examples, one in trading and one in payments. So if you think about trading, there are naturally 2 market participants in any given trade, makers and takers. Those 2 parties have opposite objectives. Takers want the best possible price, and makers need to be profitable over time. You need someone who's going to provide liquidity to the market. Those 2 objectives are naturally in conflict with one another, and exchanges spend an enormous amount of energy trying to balance those things so that you have those things in equilibrium, despite the fact that their 2 primary constituencies are in direct conflict with each other. Over the next couple of slides, I want to demonstrate 2 things. First, that on-chain order books are feasible only on high-performance blockchains, and those that are optimized around parallelism. And secondly, that on-chain order books enable both better prices for takers and consistent profitability for makers. Here we're looking at a chart that's called an order book depth chart. I know it's kind of finicky, but bear with me here for a few minutes. What this is showing are limit orders on the order book over time. The green side are the bids, meaning these are people who want to buy an asset, and the red side are the asks, people who want to sell the asset at different prices. The reason the chart is so finicky and jumpy is because there's a bunch of bots that are placing limit orders, that are canceling those limit orders, and there are people placing market orders and crossing the spread. In any market, whether it's NYSE, NASDAQ, whatever, you have this on every single pair is happening all in real time. Obviously, this is why HFT is called HFT. Lots of quick, small interactions are happening. If you're going to do this on-chain, every limit order, every cancel, and every market order are going to be an on-chain transaction. And the only way you're ever going to make that happen across hundreds or thousands of different markets simultaneously is going to be with parallelism. There's just no way to pipe this much stuff through a single processing core. All right, now let's get to takers. Takers want the best possible prices, which means they want the tightest possible spreads. That means on this chart, lower is better. For this analysis, we're going to compare the ETH-USDC pair on Phoenix against the ETH-USDC pair on Uniswap. Most of you have probably heard of Uniswap, but you may not have heard of Phoenix. Phoenix is the leading on-chain order book protocol. It launched on Solana a few months ago, and actually the founder of Phoenix is going to come on stage right after me. On this chart, we can see two lines. There's the flat red line. That's Uniswap, and that's shown here as being 10 bips. Uniswap is known for allowing pools that offer 5 bip trading fees, but that 5 bips is measured from the mid-market price. And so the full spread from the best bid to the best ask would be 10 bips. Note that this 10 bip number here is a theoretical lower bound. In practice, any trade you do will always be worse than that because of how slippage works on AMM curves. This squiggly blue line here is Phoenix, again, for the same ETH-USDC pair. To produce this analysis, we measured 59,000 data points or time points over roughly 30 days. Of those 59,000 points, roughly 55,000 of them, Phoenix offered tighter spreads. That means roughly 93% of the time, Phoenix is tighter than Uniswap here. The data here is pretty clear. Order books offer tighter spreads than automated market makers. And the only way you're going to build that on-chain is with a high-performance integrated chain. Next, let's consider the other side of an exchange, the market makers. On this slide, we're looking at market maker profitability. On the left-hand side, we can see LP profitability on the ETH-USDC pool and Uniswap. And it's pretty clear, these guys are losing money. That should be going up, not down. On the right-hand side, we can see market makers on the Phoenix protocol on Solana. And here we can see that they're consistently making money. I do want to note, this is not a perfect apples-to-apples comparison. Unlike the last slide, Phoenix is only a couple months old, and so we just don't have 12 months of data to pull. However, we do believe that this analysis would hold if we extended the time horizon. The Uniswap team also wouldn't contest any of this. They publicly acknowledge that their system is currently producing losses for their market makers. With that said, so automated market makers, at least in their current form, are just not going to sustain over time for major pairs. This is now pretty clear in the data. The only way we're going to have sustainable on-chain price discovery is if we have order books, and the only way we're going to have order books is with high-performance integrated chains. All right, now let's get to payments. Visa started a program about a year ago, settling some transactions using USDC on Ethereum. A few weeks ago, they announced that they expanded the scope of that program to include Solana as well. The modern payment stack can be a little bit complicated, so let me try and walk through this. On the left-hand side, we have issuers. These are banks. Think Chase, Bank of America, et cetera. These are the guys that issue debit and credit cards. To the right of Visa here, we have acquirers. These are companies that provide terminals to merchants that you swipe your card in. The two that are involved in the program today are Nuvei and WorldPay. WorldPay actually happens to be the largest acquirer in the world. And then, of course, we have Visa here in the middle. Visa provides the network that when you swipe your card, that allows the issuers and the acquirers to talk in real time and make sure money's there, and et cetera. And then Visa also actually faces both parties for settlement. That means issuers pay Visa, and then Visa turns around and pays the acquirers. This is important because this minimizes counterparty risk for the acquirers. There are cases in which banks don't fulfill their payment obligations, and so Visa actually ends up dealing with all of that with the banks on behalf of the acquirers. Because bank wires are slow and expensive, money does not move from issuers to Visa to the acquirers in real time. Instead, those numbers are tallied up, and then they're netted and settled every so often. In some countries, settlement can be as long as 28 days, although most is closer to 3. These settlements end up becoming very complicated, especially when you're traveling internationally in dealing with FX between different banks in different countries and weekends and holidays and these kinds of things. That every day that goes by increases counterparty risk, it increases capital costs, and is difficult for everyone involved. Under this new program that Visa has started, issuers are starting to pay Visa using USDC on Ethereum and Solana. Visa is then turning around and settling using USDC again to the acquirers. This is not still happening in real time just yet, but they are now running this every 24 hours, weekends, holidays, New Year's Eve, Thanksgiving, you name it. Ultimately, we think that these settlement times will be reduced from 24 hours to be even faster. Visa is looking to expand this program from the initial scope of issuers and acquirers. But in order to do that, they need strong guarantees around low gas costs and low latency. As they noted in their press release a few weeks ago, this is precisely why they expanded to include Solana. Over the next few years, we're expecting that this program is going to continue to grow and expand, to have more banks and more acquirers all over the world. My ultimate hope for this program is that we get to a point where we have real-time settlement, meaning when you swipe your card, money flows automatically to 3 parties: Visa, the acquirer, and the merchant. We're not too far away from this happening, and now the path is pretty clear to get there. Multicoin is going to turn 6 years old in just a few days here on October 1st. We spent a lot of time thinking about the use cases and applications for crypto. We found a lot of clarity in recognizing the very simple nature of these systems. They keep track of who owns what. And the natural thing to do with a list of who owns what is trading and payments. Both in reasoning from first principles, as we did in the theory section of this presentation, and in looking at the data, as we did in the practice section, we can see that high-performance integrated systems are the right way to build trading and payments, because you need to be fast and cheap. It's taken a little bit longer than we would have liked to get here, but we think the ecosystem is finally ready to start ramping up real economic activity on these crypto rails. Thank you for your time this morning.